Santa Claus skipping his visit to Wall Street at the end of last year, beginning of this year. But our next guest still saying that several factors can lead to a market rally in the months to come. Joining us now to break it all down, we want to bring in Zachary Hill. He's Horizon Investments Head of Portfolio Strategy. Zachary, it's great to have you here on Yahoo Finance. So talk to me about some of those factors. Why are you concerned about that lack of a so-called Santa Claus rally? Why that maybe isn't signaling something a bit more bearish for the months ahead?
Yeah, well, great to be with you and Happy New Year. Santa Claus rally is one of those things that it's a statistical anomaly. It appears in the data, but if you really look at it, it doesn't tell us anything conclusive about the following year. We've had two really strong years for the S&P back to back, so that probably means that this year is going to be a little bit more tempered in terms of its overall returns, and we're really looking for earnings growth to be the major driver as opposed to the multiple expansion that we've seen over the last few years as the Fed has taken their foot off the gas a little bit. So we continue to see strength in the underlying economy, and we do think that feeds through to earnings and to stock prices, just maybe not as much as they have over the last 2 years.
Okay, so all that considered, as you're looking at these three drivers for markets in 2025, what needs to take place to make sure that these all come to fruition?
Sure. Well, earnings growth, we're going to get some updates very soon, starting next Wednesday, I believe, with the big banks. So we'll be paying quite a lot of attention to, just obviously the fourth quarter, but also, full year guidance for 2025. On the Fed side of things, we have seen a little bit of a shift in terms of the market's overall thought process for how they're weighing growth and inflation. That hasn't been terribly helpful, to interest rates or to equity valuations. So we are a little bit lower, on the S&P and small caps, even lower than where we were before the Fed cut rates in the middle of December. But really abstracting from all of that, our most important view around what we think about Fed policy is they're still talking about cutting interest rates, and they're not talking about raising rates. And so that's going to continue to be something we can argue about if it's going to be 2 cuts or 4 cuts or what have you. But really the bigger picture and the more important one for investors, we think, is the fact that we are going to get cuts this year. And then the last thing would be, the labor market. We get an update on non-farm payrolls on Friday. That's really important for continuing to fuel consumer spending, especially with interest rates as high as they are. Debt is expensive, and so people are spending out of incomes. They need to have jobs to have incomes, and so that's something that we're going to be watching quite closely. Zachary,
when you take a look at the fact that the 10-year yield, right around 462, I guess at what point is that a challenge for some of those earnings growth expectations that we do have going ahead to 2025? And do we need to have a bit of a readjustment here in terms of lower rates here for yields in order to achieve some of those earnings growth expectations?
Yeah, we definitely have seen a pretty sharp repricing in yields over the last month, and I think that's been reflected in terms of the way the market is traded. December was not a great month for the S&P, down marginally, but things like small caps have completely unwound their so-called Trump bump from the election period. We're right around those same levels as we were before the election in early November, and so we do think a lot of that move higher in rates has already been reflected in price action, which means for us, and a continued bullish view of the underlying economy, means that it sets up really well for those parts of the market in 2025.
What about some of your wild cards that perhaps you're keeping an eye on going into this year and amidst the early innings of this year?
Yeah, a couple wild cards. One, is around the level of interest rates. We're not at that level where it really starts to hurt, the underlying economy, but we don't believe that rates don't matter. They will eventually start to bite on underlying economic activity. The reason they haven't thus far is that consumer balance sheets are just really, really strong, and that's a function of all of the things that we did during COVID, the appreciation in home prices, the appreciation in stock prices, all of those types of things wrapped up together means consumers have been more resilient to interest rates. Companies also have termed out their debt, which means they're more resilient to interest rates, and so that's something that has been a feature of the last 2 years and has really confounded a lot of forecasters. We are not extrapolating that necessarily for the next 2 years, though. Eventually, higher interest rates will start to bite on economic activity, and so that's something that we're going to be watching for as a wild card in 2025. And another one too is just potential volatility from the new administration, and we saw some of that this morning with a unsourced article in the Washington Post, and then a tweet refuting that around tariff policy. The way that we're thinking about, the incoming administration, there are some, policy procedures that are really positive for markets and some that are not so positive. And so as investors, we're going to have to continually weigh the positive and negative as the news flow evolves over the coming year. And so that's another thing that we're going to be paying a lot of attention to.
Zach, really great insights. Thanks so much for kicking off today's trading activity with us. Appreciate it.
Thank you. Happy New Year.
Happy New Year.